America's better positioned to lead the world than we ever have been. We have the strongest economy in the world. Our inflation rates are lower than other nations in the world.
Okay, quick fact check there for the big guy. The U.S. inflation rate is now 8.3%, which is higher than all the G7 nations that you said that in front of. So the question is, why does he keep lying to us about this strong economy? Same thing with Jay Powell. The Atlanta Fed just lowered its Q2 GDP forecast to negative 1%. So if that's right, it means that while Biden and the Fed chair have been declaring how great our economy is, well positioned, we're in the midst of a recession. Joining us now is Peter Schiff, chief economist, global strategist for Euro Pacific Capital and the host of Schiff Radio. Peter, you've waxed poetic about what kind of condition our economy is really in. It's worse than even I just stated, is it not?
Well, it's been in recession all year, so the whole time they've been bragging about how strong the economy was. In fact, Powell was saying the economy is so strong it can easily withstand higher interest rates. It was in recession the whole time. But you got to think about this, Laura. If we're already in a recession because we had negative 1.6% in the first quarter, and if the Atlanta Fed is right, it's -1. It may be even worse than that. But we still have near record low unemployment, at least the way the government scores it, which is not very honest. But if we're already in a recession with low unemployment, imagine how much worse this recession is going to get when employers start reacting to the recession by laying off their workers en masse, and as the Fed continues to raise interest rates and as inflation continues to drive consumer prices higher. Yeah, and of course, the reason we have so much debt is because we were in such a low interest rate environment for so long, thanks to the Fed. And now that the Fed has to raise interest rates, it's basically pulling the rug out from under the economy, because now the debt is completely unsustainable, especially if the Fed actually raises interest rates high enough to successfully fight inflation, because so far they haven't even come close.
So, Peter, how much do interest rates have to go up in order for us to put the brakes on this?
Well, you got to get interest rates to be higher than the inflation rate at a minimum. So if inflation is 8.5, you're talking about maybe 9.5 at a minimum. Well, obviously, with all the debt that we have, nobody, including the federal government, can afford to service the debt. But we're not going to get a hold of inflation until we cut government spending. We've got to get rid of these deficits that the Fed is monetizing. And nobody in the Biden administration is talking about reducing government spending. In fact, all their plans are to spend even more money when they're supposedly complaining about inflation. Inflation is the tax that we're paying to finance all their spending.
I'm not sure inflation has peaked, Peter. We are looking at oil in the aftermarket above $122 a barrel. We've got RBOB gasoline up 1.33%. Nat gas is moderating slightly today. But what do you think happens? And don't you agree that the Fed has to raise rates to tamp down inflation?
Well, they have to raise rates a lot more than they've raised them and a lot more than they're contemplating. The hikes that they're talking about are too little too late to do anything about inflation. But more particular, the government needs to dramatically reduce government spending. We need to see big cuts in middle-class entitlements, or we need major tax increases, not on the rich, because that will reduce investment. We don't want to do that. We need more supply. We need less demand, so they have to increase taxes on the middle class. Either raise the payroll tax or maybe introduce a national value-added tax or a sales tax. I would prefer spending cuts, but if they don't do one of those two things, inflation is not going to go away. Inflation is going to get much worse. We're nowhere near peak inflation. This inflation is just getting started. I mean, we've had it for a long time in financial assets, but now it's finally moved into consumer goods, and it's got a long way to go.
The Fed's GDP tracker is pointing toward a recession, and the World Bank is obviously coming out and saying that most countries are headed for either recession or stagflation. Peter, are you saying we need a full percentage point hike?
Well, we need more than that, and it should have already happened. But not only are we likely entering a recession, we're probably already in one. Remember, we already got one negative GDP quarter in the bag. The Atlanta Fed just yesterday reduced its estimate for Q2 to 0.9, so we could very easily be in another negative quarter. But this is not just going to be a recession. It's going to be the recession. It's going to be much worse than what we now call the Great Recession, which followed the 2008 financial crisis.
We've got a great tight labor labor market.
No. We have a bigger bubble now than we had in 2008. And when the air comes out of this bubble, it's going to leave a much bigger hangover than the one we had then. The difference is there can be no bailouts this time, no stimulus, no TARP, no QE, because if the Fed tries to do that, if they try to stimulate the economy in the next recession, when inflation is already double digit, and remember, we're not even measuring it correctly. We're using a highly flawed CPI. If we were still measuring prices using the CPI we had in the 1970s and 1980s, we would be closer to 20%.
Peter, where does it work to put your money? You have been a gold bug, but you also have other opportunities that you see. I mean, what should investors be looking at the moment from your perspective?
Sure, gold's a part of my portfolio. It's a small part because it's savings, it's a store of value. Most of my money, personally and for clients, is invested in dividend-paying stocks. I don't like fixed income at all. I agree that if you're going to do it, don't go out on the long end, because that's where you're going to get killed. But even in the short end, you have inflation risk, not as much interest rate risk, but inflation is going to erode away the value of your principal. I own a lot of stocks, mostly outside the United States. I own some companies in the United States, mostly energy companies, but I own stocks that pay me dividends of 5%, 6%, 7, 8%, sometimes 10%.
Well, look at, the Euro-Pacific International Dividend Fund has a very good 3-5 year.
Yeah, I would much rather get dividends from companies than clip coupons on bonds, because the companies that I invest in sell products that people have to buy, not the ones that people want to buy, because they're going to stop buying those. The ones they have to buy, and they'll pay higher prices, and then I can get higher dividends to stay ahead of inflation.
You said it very confidently. We are nowhere near peak inflation. Then we get this number, and it clearly indicates that you were correct. Do you anticipate an intra-meeting rate cut, almost an emergency type of situation, or a 1% hike, rather, a hike in interest rates? What does the Fed do next to get their arms around the situation?
Well, I don't think they're going to do something intra-meeting. They meet next week, but they should. They should raise interest rates by a lot more than 100 basis points. But even if they were to raise them by 100 basis points today, it's too little to make a difference. It's not going to solve an inflation problem. This has been 12 years in the making. The Fed has been flooding the economy with inflation since they launched QE1, and now we're drowning in it. And there's no way to mop up this mess with, 1-2%
not even, hold on,
hikes.
Peter, not even a 75 basis point hike in July, which is what the markets are pricing in. That will do nothing.
Liz,
that's water off a duck's back.
Inflation is 8.5%, and that's if you believe the CPI, which I don't. It's actually more than twice that. If they raise interest rates 1%, rates will still be under 2%. That is a highly inflationary monetary policy. The Fed needs to slam on the brakes, not ease up on the gas pedal. We need interest rates above the rate of inflation. We're not even talking about getting anywhere near the rate of inflation. And we need the federal government to cut spending dramatically. They have to eliminate the budget deficit. The inflation is coming from deficit spending that's financed by money printing. And we've been doing it for a long time. It is a huge tax on the American public, and it's not going to go away.